All right, good morning, everybody. You know, for not having much economic data, we're getting a whole lot of running around doing nothing. Yep. Okay, first things first, let's try to help out the new people in the room. Back in the day, we didn't have a Discord. I guess I should do a sound check first, make sure you guys can see my screen, you can hear me talk. Órale, way, you hear me? No. Ay, chingao, pinche güero. Check, check, check. All right. So we didn't have a Discord back in the day, and we needed a place to be able to share documents. This Stream app that we purchased about a year or so ago, we were using like Join Me, then we used something else, and then we got this. There is a room drive here. So if you look across the top, there's a manila folder looking icon. It's called the room drive. We don't really use this much nowadays compared to what we did, but it still has things in it. And if you scroll down, you'll find indicators and white pages on indicators. You will also find examples of trade journals. So even though we really haven't talked about the room drive in a long time, it is still there. And the things that we had stuck in it are still in it. All right, so there's that. When it comes to journaling trades, I have tried all kinds of things. And when I first started, I was not very good at Excel. So I was mainly trying to download everybody else's Excel. The problem with that is people journal different things for different reasons. And somebody else's Excel spreadsheet, one, I wouldn't quite understand all the parts and pieces that were in it. Two, I wouldn't know how to exactly use it the way it was designed. Three, if I broke it, I didn't know how to fix it, and it wouldn't have things in it that I wanted in it. So journals in an Excel or on a document of some form, they're okay to a point. They can kind of give you an idea of perhaps what a journal may need. But at the end of the day, your own journal is going to be the best journal you could ever have. And I wish I could point you to one single document and say, this is perfect. And if you just use this, you're going to be good to go. Unfortunately, making 10, 12, 30, 50 different journals along the way is going to be a part of the growing process. What I eventually came up with is a massive data collection database. And then from there, I build out individual journals for what it is that I want to do. Because I don't just trade options, I trade futures, I trade stock, options on futures, options on stock. So kind of all over the place. I needed a journal that could deal with all of those individually. So unless you are specifically only doing one thing like stock, you're eventually going to find that you need more than one journal. What goes into the journal, from my point of view, is ways to document what I'm trying to do so I can continue to do it consistently. And then my trade results. What was I trying to accomplish versus what I actually did accomplish, right? So kind of two different things. We sometimes use those journals for developing back test research or gaining more information about a strategy. But a lot of times people think a trade journal is nothing more than just documenting, I got in here, I got out there, I made X amount of money. Little bit of a tip, your broker does that for you already. So if that's your only conditions for making a journal, save yourself the trouble and just look at your broker statement. They're going to tell you where you got in and where you got out and how much money you made. right? And then you can just download that and you're good to go. So from the perspective that journals can be multiple things, I'll give you guys a little bit of a tip that I picked up along the way, and it comes from Discord. You can make your own Discord, and they are absolutely amazing. I run 2 computers from 1 keyboard and 1 mouse. So I've got documents on both of these, and then I'm often on an iPad. Sometimes I use a tablet. Sometimes I'm on my phone. If I'm trying to keep track of a document, maybe I forget to put it in the cloud, or I'm looking at the wrong version. It's the old one. It's not the new one. It didn't sync. It just becomes this really big hassle of trying to keep track of data. And then when it comes to videos that I've watched or books that I've read, which ones did I read? Where did the pictures go? Yeah, it just becomes this massive amount of data that you're trying to sift through and keep organized. Well, if you start a Discord, which is, if you look at the left side of your Discord, it has a little plus sign that says add a server. It's free. It doesn't cost you anything. It's private. You're the only one that can see it unless you invite other people in. You can modify it with bots that will do all kinds of things for you, including grab stock, show you what's trending. It'll do all kinds of amazing things. Creating your own Discord is a really great way to develop educational content, strategies, your playbook, record your journal entries, everything you would want to do. And it synchronizes from your phone to the web to different computers, all seamlessly, so you don't need to learn how to code. So for an example, I've been developing a trend day playbook. And in here, I've just been gathering up examples of different contexts, different trades, different setups. And it's nothing more than just importing a picture. It takes no effort at all to just take a picture, throw it in there. Annotate on it. If I don't like it, I throw it away. If I want to move it somewhere else, I can move it somewhere else. It's just very simple and easy and very efficient way to organize data. So make your own server, make your own Discord, and use it in your development, from playbooks to trade ideas to even just keeping track of the trades that you take. There's so many different ways to do this. I do like an Excel spreadsheet because it will calculate things for me. Discord won't calculate things. So I still use my spreadsheets, but there's a time and a place and a purpose for everything. So I definitely wanted to point that out. Don't sleep on the idea that you can make your own Discord. It's a very powerful tool. One of my main Excel documents that I've had for a long time has strategies built from back when the bullish bears still had different trade rooms, like the swing trade room and the day trade room and then the futures room, and we had all these different areas. This was a trade setup we had developed for a Heikin-Ashi indicator. And as I seen in the chat earlier, Heikin-Ashi is not candles. It's not price action candles. Let's say it that way, because obviously they are candles. They're not price action. So if you're trying to look at open, high, low, close, develop support and resistance, trying to draw lines on a Heikin-Ashi for support and resistance would be like drawing lines on the RSI for support and resistance. You can do it, but it's not price action, right? It'd be like using stochastics or RSI, and there's nothing wrong with that. You can seek divergence and all kinds of things, but it won't be validated support and resistance. But we did develop this strategy. In this strategy, you can see I had a list of tools that I would be using, or indicators, external notes about other things I may need to know to be able to do this strategy, which is often one of the inherent default problems of any strategy. If somebody is doing something that they spent 3 years developing and you see them do it and they're making killer money and it's just totally amazing, you're like, yes, I'm going to go do what that person's doing because they're killing it. Yeah, well, they put 3 years of effort into building a strategy. You won't be able to just come along and watch 1 or 2 videos and show up to work the next day and have a killer trading strategy. It's not going to happen. And yet, if you build your own strategy, or even if you take theirs and you modify it or break through every single piece of it step by step, then yes, somewhere along the way, 1 year, 2 years, whatever, you're going to get to the point where you can also kill their strategy. But making your own will mean that you actually understand the parts and pieces inside of it. So strategy development oftentimes starts with just looking what somebody else has done, the things that they focused on, and then you going back and focusing on those same things and learning about each one of them. I had the trade vehicle listed. What was I going to be using? Because we can do stocks, options, combination of stocks and options. What was the strategy going to employ? What was my fade rules going to be? What kind of fractal analysis was I going to use? Can the trade be identified from scanners? What kind of profit targets were I going to focus on? What would be a trigger for trade entries? What would be a trigger for trade alerts? What time frame would I be doing that analysis on? So you can see that there's not a lot of complex parts to a strategy, although it can become as complicated as you want it to be. It doesn't need to be. And then, of course, one of the things that I always keep track of, trade failure. How can I identify that the trade is failing so that I can get out of the trade? So that was a Heiken Ashi trade criteria. This was a fractal energy trade. Same strategy concept, same structure, same build. What tools am I using? What time frame am I analyzing? And just on down the list. Take profit, fade rules, analysis platform. What external information do I need to know to be able to run this strategy? Can I do it with a scanner? So when you're putting together a strategy, list out the parts and pieces and components of that strategy so that you don't get sidetracked. And it's very easy to get sidetracked. There's so many things in the trading world. Fundamental analysis, technical analysis, market breadth. There's 1,000 different indicators and inverse markets, and the list just goes on and on. So if you develop a list, it keeps you focused on that. And nobody's saying you can't add to it later on. Maybe you learn something new in life, you reevaluate a strategy that you've already got, you add that new thing to it. So today I wanted to go through the steps of developing a strategy, just like we did here in these videos. And you can find these videos. They were part of a live stream. They're not like Next Level or something, so they don't have a name. But if you look back in the archives of 2018 and early 2019, you'll see that there was a swing trade room, and it would be me streaming, of course, go through and hunt them down. I guess it would be a little bit of a chore. So one of the things that we're going to be focusing on when we're building a strategy is that it has to suit you. It has to suit your account, your skills, your bias, your trade logic. Are you trying to trade direction? Do you even care what direction the market goes? Does it have to move a particular distance before you're profitable? What are you trying to accomplish? These names here in the upper left are the different styles of trading that are out there. It's not a complete list, but it's the most popular. So if we were going to do gamma trading, that's usually a tactic that we do on Thursdays and Fridays, for an example. So if we're going to build a trade strategy out, it would have to include what day of the week, how high of a gamma level we're going to be trading, how we identify targets, a way to journal our success and failure so that we can validate that the trade is successful. Gamma trading has a win rate of about 30 to 35%. There's nothing wrong with that. It's a good win rate considering that the risk to reward is like 9 and 10 to 1, right? I will risk $1 to make 10. Heck yeah. Especially when everything else falls into place. So we want to have examples of these different strategies, what it can look like, and how we start to put it together. I run a credit spread called a public credit. Every strategy that I run has a name. It makes it easier to journal. That way, once the strategy has been developed and I am journaling the trade, I don't have to sit there and try to excruciatingly in detail describe what the trade is. I can just refer back to the name of the trade. A public credit spread is focused on near or at the money credit spreads with near a 1-to-1 risk to reward ratio starting the trade out. These are the rules that I have developed for that strategy, and this is a complete breakdown of that strategy. So if we're doing this in that Excel document, we would be identifying these characteristics. I want you guys to focus on the idea that a lot of this isn't necessarily looking at the options yet. We're still looking at a market, right? Trying to figure out, do I want to put a trade on in this market? And then we bring the strategy in. So some rules that I use in this at the money credit spread strategy. All right there. If I'm going to be putting on this swing trade, I don't want to see any earnings in the next 30 days. I don't want any dividends in the next 30 days. I don't want to trade companies less than $10. When I'm looking at the daily chart, I want to see no massive gaps and no parabolic moves. If you look at Nike, for an example, Nike would fit the bill as something that I do not want to trade with this particular strategy. Right? That right there says no, not doing that. It's got a massive gap. It went parabolic. It is absolutely not something that I would trade with this strategy. These basic rules here on the no gives us edge. It helps us identify trades that we should not take. And the reason for this is we can find our setup, the thing that says, hey, this looks like a good trade. I know this trade. A flag, cup and handle, head and shoulders, breakout. There's all these different patterns and setups that we can identify that says, hey, this is a good trade. And yet, if it has earnings coming in that window that we're looking to trade, it wouldn't matter how good the setup looks. I don't want it. If it has dividends coming, I don't want it. It's by using those rules that I help eliminate elevated risk. And maybe I walk away from a trade that would have been successful. I'm okay with that. Walking away from a trade that would have worked did not make me lose any money. It didn't hurt my account. It didn't hurt my self-respect. It didn't hurt my feelings. I get to keep my money, survive to fight another day. And then we move into the next piece. What would I need to see on a chart to take a trade with this strategy? There's two main ways that I like to trade when it comes to a swing trade in the market. Either I'm getting in on a breakout or I'm getting in on a pullback. It makes sense, right? AMD today is on a breakout day. It's formed this cup on the daily, not a handle yet, just a cup. But we've got a cup here and we are breaking out of a major level. This would fit the bill for a breakout trade. When it comes to a pullback, Ford has a pullback. You can see that Ford was running in a decent trend ever since it left this range back here. Broke out to a new level. Had a pennant. Broke out from that. And then has been fading down since then. So, pullback. These aren't the only two ways that we can trade in a swing trade, but for this strategy, they're the two that I want to use. What I'm not interested in doing is getting in somewhere in the middle of nowhere, right? Somewhere I'm not at the top of a range. I'm not at the bottom of the range. I'm kind of somewhere in the middle of the range. It's not breaking out and it's not at support. I really don't want to trade that. Now, what we've been talking about is one single strategy, this at the money credit spread. Finding price resting on a moving average, like a pullback to a 20. Resting on a previous price pivot, like a trending market that pulls back to its last 100 line on the Fibonacci. Resting on a trend line, like an angular support or an angular resistance. Or on the breakout side, breaking out of a fib, breaking out of a price pivot, breaking out of moving averages, or breaking out of an angular trend line. There are those other gapped up markets, and this is more of a close in. I shared some of these pictures last night. If we were to scroll up through the chat in the overnight hours, we had markets that presented a red day yesterday and then gapped up off of that for a really nice breakout day. I picked up this tactic from TD Ameritrade webinar series. After they sold Thinkorswim, they used a lot of that money to build out their education department. They've been running a bunch of webinars and all kinds of things like that. So here on SPGI, we had this set up just the other day. It would be on a red day like this, where we close in the lower half of the red day, as close to the low of the day, the better. And then in the next morning, in the pre-market, it rallied all the way up, gapped up in the pre-market, and was going to open above yesterday's open, and even better, opening above yesterday's high. It didn't open above yesterday's high, but it did open above yesterday's open. We did have some fade, and that's all right. I mean, you know, it'd be better, of course, if it didn't do that at all and just immediately starts running. It's more of a trade trigger, but had a little bit of fade, and then away it went. This thing just took off, and it was a beautiful trading day. So when I get a gapped up market, I really want to see that it gapped up in the pre-market after a red day, not a green day. I don't want to see a strong green day and then a gap up in the overnight hours and we open yet again even higher than that previous day. It's tradable. I'll do it. I don't like it. It's not as good as a setup. And you can see plenty of examples where it would have worked, right? It's just fine, no problem. But these setups, I find, have greater follow through, right? And you get less of that fake out breakout, that blow off top capitulation reversal kind of markets. Which is why it's in the rules. Finding a red day yesterday at or near support, meaning maybe that red candle faded down to a 20-period moving average or a 50-day moving average. If we're going to trade a market off of support, it has to have gone down to get to that support, right? So we can't trade a market that ran for the last 3 days to the upside and then get in and call it support, right? It's been running towards resistance, not fading to support. Oh, I just got a mocha frappe. Thank you, Pippi. So a red day at support or a red day that closed near the low of the day. I like either one of those. An IX10 pattern, which is basically saying a market with an inside day. I also shared an example of that yesterday looking at daily charts. This wedge here would have been an example of an inside day. We could use that big green candle, or we could look at this red candle, either one. The bigger the wedge, the less exciting the compression, right? Because it's not compressing much when it's a really big candle. So we want inside days that form behind small candles. The smaller, the better. If we use that red candle, you can see that we had 2 days after that red day where we stayed inside that range. That's an IX10. And what you find after multiple days of compression is that you usually get a market trying to blow off steam. A big breakout day. This one day is 3 times as big as these past 2 days. Another gap I'll take is, just like we discussed, a market that gapped above its previous day open. And of course, we can add to that the previous day's high. Now, of course, before I get into a trade, I kind of want to ask the question, what if I'm wrong? What if it failed to support and I get in thinking that that support is actually going to hold and then it doesn't and it dumps even lower on me? If it does dump, where is it going? What's the next lower level of support? And am I comfortable with that? Because I can roll down these trades. So I'm not going to be too hung up on the idea that, oh, it broke support, my trade is losing. I can roll it down if it does find support at the next lower level. So if we're looking at Ford, suppose it comes down to this low that we've got identified, and we decide that is support, and we pull the trigger and we get in it, and then it starts to fail after we get in. We got to have an idea of, well, where are we going? Where's the next level of support? And am I comfortable holding on to it until it gets to that level? We're looking at about 13.5 from 14.5. It's a $1 move lower. If I'm comfortable with that answer, then I can go ahead and take the trade. If I'm not comfortable with that answer, I have to adjust my rules on what I'm going to do if it loses, that it breaks support and I kill the trade and move on, or that it breaks support and I take a trade on the other side. In this case, it would be either putting on a a put debit or a call credit. And that way I can try to recoup some of the losses from that trade without ever actually closing it, doing something, right? So identifying ahead of time, what if? What if I take the trade and I'm wrong and it begins to lose? We get that identified, still like the answer, then it still becomes a tradable opportunity. And all of that just goes right into the journal. And of course, keep in mind, if we do have to roll a trade, if it does fail and we end up having to modify it, add another piece, or do something with it, we're going to get stuck in the trade longer than we had originally planned. Are we okay with that? And again, if the answer is yes, great. But we got to look ahead and ask, all right, well, where's earnings? Right? Because we still got that problem with earnings as a part of the plan. Where's earnings? And if I add on an extra 30 days, is that going to put me in a 30-day window for earnings? It's by doing these kind of steps that we can eliminate a lot of trades that are elevated in risk, because we can have a really great strategy based on what we see on the chart. And those can win with a high degree of frequency because the candles do what we thought it was going to do. The market rallied from there, it fell from there, it stayed in a range, we hit our goals. But it's the sneaky stuff that gets us. A dividend that we didn't know was coming, and earnings that we forgot to look for. These very simple, very obvious things right under our nose that says, hey, if you take that trade, you're getting into something with way more risk than you originally thought it was. I noticed that my analysis on the NASDAQ was right. I decided this morning I wouldn't get into this thing for a swing trade or for a morning trade unless it left that range. Because if it left that range, we were going to be in a trend day, and that's when I would want to trade it. Dun, dun, dun. Hey, we're in that damn trend day. That's an afternoon trend day. Should have run for quite a while. Catch the pullbacks. Take it as she goes. Keep your eye on the clock. So anyways, on to what we were looking at. Next piece of the strategy, look again. Go back and reevaluate and look again. What did you miss? You sure there's no gaps? Are you sure there's no dividends? Are you sure there's no earnings? And then start asking the question about volatility. For my particular credit spread strategy, volatility doesn't matter to me whatsoever. It can be at the lowest volatility that it's ever had before, or it can be sitting at a very, very high implied volatility. It wouldn't matter. It would obviously work better for me if it has a higher volatility rank, but I don't have to have it because of the way the system is built. We're building them at the money. So if I did want an elevated volatility, then I need to check that, put it into the trade logic and say, well, I took this trade. We were at a 45 IVR, and I was able to go 2 strikes out of the money and still get a 50-50 trade setup. Cool. If you evaluate a trade and you find something wrong with it that says you can't take it, try looking at something else, right? The markets are correlated. So if I wanted, for example, AMD, and after analyzing AMD, I decide, you know what? I think it's ran too far. I feel like I'm chasing to get in this. I'm too late. I can't do it. Well, AMD doesn't do anything by itself. What are the other chip sectors doing? Maybe I go look at Intel or MU or Taiwan Semiconductors, that I find something else as a peer group to trade if I'm not comfortable taking AMD. If I still can't find a market as good as AMD in the same industry or sector, maybe AMD is only moving because of its own news, and MU isn't doing the same thing, or NVIDIA isn't doing the same thing. Then I can go and trade an ETF that holds a lot of AMD. Easiest way to find that ETF is just to use the bots on the Discord. Go into bot commands. What ETF? AMD. These ETFs have AMD in it. And this one ETF, 8% of its holdings is made up of AMD. So I can evaluate those and perhaps still gain exposure to AMD's market without actually trading AMD stock. It solves the problem of how am I going to trade this market when it didn't meet my criteria for a trade. So notice the so far, we haven't even gotten into the options yet, right? We haven't looked at implied volatility or volume or days to expiration, none of that stuff. We're just focused right on the chart. Because if it doesn't have what we need on the candle chart, there's no reason to even waste our time looking at the options. So now we do start to get into the options themselves. If we're looking at days to expiration, some of the criteria that we can use are different expirations. They adjust what we're doing. There's a 0-day at the money, which I absolutely love. Get a good $1,200 to $1,500 in about an hour. It's a nice day done in an options trade. But then there are the longer duration trades too, right? Friday to Friday style trades. The sweet spot between 45 and 60 is what Tastyworks says. They've done massive amounts of back testing, and they say that that's the sweet spot in options decay. Well, depending on the size of your account, you may not want to start building your trades that far out. Hey, Abib, right? Those smaller accounts need the capital rotation. So starting trades, 65 days out really isn't a good starting place, but 30 to 45 would work, right? Because you're not holding the full 35 anyways. You'd be cutting these things short probably around 20 to 18 to 25 days. But you can have that in your strategy on what it is that you're trying to do. Are you trying to take a short duration trade? Are you trading a market in a confirmed uptrend? Is it a market under pressure? And then from that, you adjust your days to expiration. One of the concepts behind that and why it's in my strategy here is because it's easier to try to trade when you have more time in the trade, right? It's why trading's been around since before running water was in households, right? When people still used porta potties. It's been around since before the United States was founded. Trading's been around forever. The only reason anybody's ever been willing to take a trade in hundreds of years is because they have a good idea of where the forward future price of that market is going to be. So the more duration we give a trade, oftentimes the more room we have to be right. The shorter duration, the harder it is to be right. So in a market under pressure, you may need more time for that trade to unwind and be a good trade. It'll also not react so violently to price action. So I can put on, a trade $10 wide and risk $500 in a trade, and yet that loss won't happen overnight. It would take weeks and weeks of a market underwater before I start to actually lose serious money. That same $10 wide trade risking $500, if I put it on with Friday's expiration, it will immediately start to have drastic swings in the P&L. So depending on the kind of market environment that we're in is one of the ways that I make a decision on what expiration I want to choose. Once you've dialed in the days to expiration that you want, your strategy should focus on what strikes you want. Now, when we're building spreads, And even just buying calls and puts, but most specifically with spreads, we choose how much overall risk we have by how wide we build it. If you're in a small account and you don't want to risk more than $55, $60 in a trade, you would know that you're not going to be putting on trades bigger than $1 wide. So you would want to run all your scanners on products that are small, right? Things like XLF, for an example. These have 50-cent wide options and $1 wide options. You wouldn't want to go in and target things like Tesla. And that argument of, well, I'm in control of how much I lose. I can build it $10 wide and use a stop. That's a really bad idea. That stop doesn't work in the middle of the night. And Tesla moves in extreme price action. That trade can turn upside down on you very, very fast, and you would have no control over trying to minimize your loss in it. But if you build the trade as big as what you're willing to lose, then you know that no matter what, you can't lose more than that. And the strategy would keep you focused on those options at the right size. For my account, $3 wide is about as wide as I want to go to start a trade. So if I'm opening up a one lot, $3 wide or less, I'm good to go. If I want to open more than one, I make the trade size smaller. I use strikes up to $1.50 wide or less. And then if I want a 3 lot, I got to keep it under a dollar wide. That way, if we're looking at something like XLF, and I go to put on this trade, I would know, all right, I've got to keep it around a dollar, but I can put on 3 of them. Now, these rules, none of these sizes have anything to do with your chance of success. You won't lose just because you made it 50 cents wide or because you made it $50 wide. Unless you can't sleep at night and then you go in and end up closing trades down because they're upsetting you, or you're becoming overly anxious, or you're just puking up trades like crazy. But the size of the trade itself doesn't affect our win rate. Now, according to Tastyworks, when you do widen out your strikes, you expose your trade to more of the Greeks. And if your trade requires the Greeks to help you hit your target faster, you will hit your targets faster, making them wider. But it's a subtle difference that you wouldn't notice in one particular trade. It would be something that you would notice over a year of trading a particular style. That when you build them, say it's a $5 wide trade rule. Well, on the SPX, that's one strike, right? That's as small as you can make an SPX trade. And yet you could do a same $5 wide trade on SPY and actually make it 5 strikes wide because it has $1 strikes. And so you would expose yourself to more of the Greeks in SPY, $5 wide, than you would in the SPX, $5 wide. Then we start getting into liquidity. I don't like to trade things if it doesn't have weekly options. It's like straight out of the box. If it doesn't have that, forget about it. I don't want it. Right when you get to the trade tab, it says weeklies. If it doesn't say weeklies, it doesn't have it. If it doesn't have it, I don't want in it. Not with this strategy. And I will trade things that don't have weekly options. I will, but not for this strategy. Weeklies are not something that a company has. It's something that a company earns. So if you see a company has weekly options, it's because they are liquid enough that the brokerages or the market firms, the OEC, the Options Industry, OIC, Options Industry Corp, gave them the right or the permissions to have weekly options. which is why if it doesn't have weeklies, it's not liquid enough for me. I don't want to trade it. It literally is earned by liquidity. But just because it has weeklies doesn't mean that it is, quote, liquid enough. It's just a really good starting place. Because if it hasn't even earned weeklies, heck no, I don't want that. It's not liquid enough. Other things that you can do to find liquidity is search for Sizzle. Now, Sizzle is just a thinkorswim phrase. It doesn't exist on any other platform because they invented it. And it basically means 5-day average. So when you're looking at the call Sizzle, you're looking at the average 5-day call volume. If it's greater than 1, then it's greater than its 5-day average volume. Same on the put side. The put Sizzle is a 5-day put volume. If it's greater than 1, then we're running a higher put volume today than the previous 5-day average. The Sizzle index is putting these two together and giving you the aggregate total. Where is its Sizzle today? Greater than the put call Sizzle from the last 5 days or less than the put call Sizzle from the last 5 days? Thinkorswim also has volatility Sizzle. Is the volatility today greater than the 5-day volatility average? And then it has stock Sizzle, which is volume. But, yeah. So that Sizzle informs us of liquidity. It can be another thing that we can look to and say, well, is it liquid enough? If I'm taking a day trade or a trade for Friday, I want to know about its most immediate options. Right now, are there enough people trading this thing that it's liquid? Using bid ask is another way to identify liquidity. The bid ask should not be too wide. And quote, too wide is a very arbitrary thing. How do I decide what is too wide, and how do you decide what is too wide? Something like XLF is a $36 product, and it has a 4-penny bid-ask spread. Okay, well, I mean, that's not too bad. The SPX is a $4,300 product, and it has a 40-cent bid-ask spread. That's a $40 bid-ask differential. It's a big difference, but it's a bigger product. Markets that are not very liquid have a wider bid-ask spread. Look at the volume in here on these options that have 1 day to expiration. And then look at the bid-ask. It's only $20 wide. Heck, here it's only $10 wide at the money. And yet way out here, 31 days to expiration, less than 1,000 contracts traded today. And we've got a much, much wider bid-ask spread. So this is a really fast way of looking at the overall aggregate bid-ask spread and identifying liquidity. Another thing you can identify is open interest. Now, open interest can be a little tricky because it's not updated constantly. They go back later on and they update it. So some people use that, some people don't. It still is a reflection of how many contracts are open right now, how many options in that market are in play. It's a good way to look at it. So it's another sign of liquidity. All of this combined makes up my credit spread strategy. And even with this, it still doesn't target a particular pattern on a chart, something in the candles that I would need to see that says, hey, I'm going to take this trade. But it does allow me to build a strategy and be very consistent in how I'm putting it together. what I won't do, what I will do, and how I can avoid elevated risk levels. And then the taking profit. Now, this one tends to get newer traders hung up because there's a lot of videos out there that say we need to close our trades at around 50%. And there's nothing wrong with that. But we got to use discretion in this conversation. If I have an account of $100,000 and I put on one trade in the XLF, and it's risking $100, right? Because I got 50, they got 50. That's the entire size of the trade. And after I get in this thing using the 3637, say the XLF tomorrow explodes and goes all the way to $50. And now I'm in a trade that is still time-based. And in that move, volatility went up so high, my trade is not profitable at 100% profit. I'm sitting somewhere around 28 or 30% profit, maybe closer to 40. And I'm thinking, well, I can close it out. It's almost a 50%. In my $100,000 account, I don't need this $100. The market is so far away from me that I'm feeling absolutely no threat or danger. Why would I close this down? I don't need the capital to open a new trade, and I'm not feeling any heat. I'm not in threat or danger. There's no reason to close that trade down other than some arbitrary video that says if we close our trades down early, we tend to win more often. And that's absolutely true. So look at the overall situation and then approach that profit target conversation. If my entry is at the low of this candle and I'm in a credit spread and we're dangling here inside of this candle and I'm winning, I mean, I'm getting up there in my profit, I'm at 30, 40, 45%. I'm still sitting in a lot of risk in this trade. I'm going to get mine and move on, close it down and lock in those profits. But if I get in and my break even is that yellow line and then the market explodes all the way up there, if I don't need the capital, why the heck would I close this thing down? Right? So approach profit taking with a little bit of common sense behind it. If you're in multiple trades, fading is probably a really good idea, especially if it's still in that range bound candle, right? If we're still sitting down here in that green area and we get 5 of these on, maybe a 6 lot, a 5 lot trade, we hit 25% profit. Yeah, lock in some gains, close some down. Because we're still in an elevated risk environment and we're holding multiple trades. So this is the construction and the setup for a swing trade and all of the various parts and pieces that go with it. It's not an exact science. If you're trading naked options, you're going to want different criteria. If you're day trading, you're going to want different criteria. But hopefully this gives you a glimpse of the kind of things you want to look at when you're building a trade plan, a trade strategy, and how a lot of it had to do absolutely nothing with the options chain whatsoever and focused solely on what kind of markets do I want to trade. And you can add to this so much more. Market breadth, overall market trend, analysis on the peer group or the industry that you're trading. You can add fundamentals to it if it's a particular company. All kinds of things that you can do to increase your success rate or decrease your loss rate by eliminating trades that are, quote, at risk or in risky environments, risky situations. It's not about one trade one time, right? It's about what kind of trade do I want to put on consistently. And this is just one single strategy in one single example. When it comes to journaling, though, it's not always just the strategy. What about the trades that we are taking? So when we take a trade and then we're looking at how did it go, the same concept comes in, that we can take a picture, review where we got in, where we got out, what happened to the trade. If it lost, we can ask why. Was it our strategy? Did we miss something in our analysis? Were we wrong in our direction? Or did some economic news come out and kill our trade? Because if it wasn't our strategy that made the trade lose, we don't want to change anything. So we want to know, why did the trade lose? Every trade that I take, win or lose, I go back and reevaluate. Did I miss anything? Is there anything else that I can add to the situation and be able to discuss in the future, something that might need to be changed? Was there a topping pattern that warned me of that I needed to get out? Did I know that there was going to be a Fed meeting this week and stayed in the trade anyways? Or that earnings was coming and I ignored it? So taking pictures of the trade and the stats, the wins, the losses, the follow-up, will help you articulate your win rate, your average money made in the trade. We want to make sure that we're actually getting a good return on the money that we're using, right? Some of these trades can hold a very high buying power. And if I'm in a small account and I tie up $1,000, I want to see a return for that $1,000 that I was not able to use because I had it tied up in a trade. I don't want to tie up $1,000 and then, make $25 profit. It's called a return on investment, your ROI. Here's an example of recording that kind of data. And this is not my data. Just want to point that out there. I did not put this together. And yet, if I was running a back test and wanting to aggregate the data of my trades, that would be a really great setup to look at. Right? So the journal isn't just, this is where I got in, this is where I got out, this is how much money I made, how much money I lost. A journal shouldn't be, this is the strike that I used, and this is the strike that I bought, and this one I sold. All you're doing there is documenting a trade. And there's nothing wrong with documenting a trade, but your broker will do that for you. You can download your trade results. You can do it on Thinkorswim, Tasty. Not all brokers do it. Even Robinhood will send you a statement at the end of the month, right? So you can get your trade results if all you're looking for is, this was my entry and this is my exit. Instead, that document should help you in some way. It should give you some edge, help you identify your win rate, the aggregate money in the trade strategy, the rules that you're using to identify the trade opportunity, something other than, I got in here, I got out there, I made $5. Really? Now, unfortunately, when it comes to trading, math formulas are a really big deal. I've had people tell me math is stupid. Yeah, probably, but you still need it. If you're not good at math, you're going to really, really struggle with getting a trade. To be consistently profitable in a trade, especially options. So if you are not good at math, and I get it, right? I hear it from people all the time. I suck at math. Unfortunately, it's our school system. They're designed to make sure you can pass And that's all it is, pass and fail. Yeah, you got a passing grade, you're moving on to the next thing. Unfortunately, passing does not mean understanding. And if you halfway understand one concept and then move to the next, and it builds off of the previous concept, the next new thing that you're learning, you're not going to understand that either. And it won't take long before you're completely lost and have no freaking idea what's going on. And then you say, well, I suck at math. No, you just didn't learn math. So back up and learn some math. It's free. Khan Academy is the best place I've ever found for this. But if you find something else, by all means, share it with us. Tell us what you found. That way we can point other people to it. You can search this guy's YouTube page. It's free, and it's not just math. This guy goes into everything, science and history and whatever. Really amazing stuff. This is YouTube, and it's called Khan Academy. K-O-H-N, K-H, excuse me, K-H-A-N. The story behind it's kind of cool. This guy was a market analyst or a market technician or some kind of market guy. And he had relatives who were getting into algebra in school. And he was really good at math. They were just horrible at it. And their parents asked him to help them out. So he went on YouTube and he made a video helping them with their schoolwork. And instead of making it private, he made it public, probably so that they could find it better. You know, they weren't really good at making videos and sharing links and all that. So he made it public. And instead of getting a bunch of snarky comments from other people who stumbled on his video, he actually got people saying, dude, thank you so much. That really, really helped. And can you do a video on this or on that? And it just kept growing and getting bigger and bigger. And it just spread. Schools have actually started to buy his product because he, of course, went commercial at some point, and he now builds curriculums for classrooms and has his own business developed out of this. But he still has all these free videos on YouTube that teach math concepts, and not just math too. He goes into economics, Dow theory, um, market formulas, all kinds of stuff. To me, as a nerd, I've just fell down the rabbit hole here. I was watching videos for days and days and days. It's still a great resource. So in a nutshell, we've gone through the background and the setup for putting together a trade journal. Now it can get a lot more complicated. I'm telling you, there's all kinds of things out there nowadays, um, including add-ons that you can introduce to Excel, like this add-on. It will actually retrieve information for me. Oh, what did I do? There we go. So I just tell it what company I want, and it aggregates that data. Although for some reason it didn't. I probably broke it, or I'm not saved, or some other thing that I did wrong here. But if I tell it I want to look at MU, it goes and gets the data from MU and aggregates. I think I'm in the wrong spot. There we go. Like that. So there's all kinds of tools now that you can use to aggregate data. You can prefetch information. So if you're using like one big central document to store every single trade that you take, you can build workbooks that reach back to that source and get the information. Pretty amazing. All kinds of things that you can do nowadays with Excel. Unfortunately, I don't know enough about Excel to do all that cool stuff. I mainly know how to calculate things that I'm interested in calculating, like this probability calculator, right? Kind of a credit calculator, asking the question, am I collecting enough credit for the trade that I'm about to put on, with the win rate that it has inherently built into that product? The way that I built this thing is it runs the trade 1,000 times and it asks the question, well, if I did this trade 100 times, 1,000 times, whatever, at the end of it, would I be more successful or less successful? Will I have made money or not if I hit that win rate that it says I should hit, right? And when it comes to credit spreads and butterflies, iron condors, we can calculate a pop, a probability of being profitable. Even just buying a call and a put has pop calculators. And so we already know what the win rate is before we even take the trade. So if I'm putting on a $5 wide trade and I collect $225 in credit, and I'm going to close the trade out at 75% if it's profitable, and I'm going to close it out at around 2/3 loss if I'm not profitable. One win would make $109. One loss would be $277. If the trade was run 100 times, I'd make around $6,100. That would be 11,500 in profits, I'm rounding, and 5,500 in losses, which would overall give me an average win on the year, right? So just simple math, just running the same trade 100 times and saying, well, if I won 70% after commissions and everything else, this would be my profit. Although I can tell you from running credit spreads nonstop for the last 2 years, they tend to have about a 70 to 75% win rate no matter where you build them. You can build them at the money, you can build them out of the money, build them $2 wide or $20 wide. They still have about a 70% win rate. At least mine do. And since I know that from journaling my own trades and from the styles that I use and managing them when they go wrong, I don't really sweat the small stuff. I'll build it at the money, out of the money, kind of go wherever I want. I still know it's carrying that inherent win rate of about 70 to 75%. And that's because credit spreads have a built-in edge. It's just the way it is. It's there. And when you add the other edge to it, avoiding earnings, avoiding parabolic moves, avoiding dividends, you increase your win rate just from that. And those things aren't showing up inside of the calculations for pop. Song, I literally copied and pasted everything. All you got to do is scroll up, homie. I copied it word for word. So let's revisit your question there. What's the days to expiration for the credit? Which one? Now, the good thing is this is recorded. So you're going to be able to go back and watch whatever you missed because you missed me talking somewhere along the way. So if you're talking about this document here, in aggregate, no matter what kind of credit spread I run, whether I'm doing it 1 day to expiration, 1 year to expiration, 6 months from expiration, it doesn't matter what credit spread I run. If I build a credit spread, it has a 70% chance of winning, no matter where I build it, and no matter how I build it, and no matter how long the expiration. I've proven that in my own trading records for the last couple of years. It doesn't matter where I go. I've broken down my trades from 0 days, Friday trades, short duration, less than 30 trades, 45-day to expiration trades, 90-day trades, and a full year trade. Each one of them individually carry that 70 to 75. And then in aggregate, carry that 70 to 75. So it is. And there's no way that we can plot that out and be able to break it down other than that there is an inherent edge on the sell side. We all already know that. But there's also an inherent edge if we add edge to the trade, like avoiding earnings and avoiding dividends and avoiding parabolic moves. Because we do those things, it increases our win rate or decreases our loss rate, really, which if you decrease your loss rate, you automatically increase your win rate. So that 70% is across the board on any credit spread that I've been building. And I checked and checked again and then checked again. The numbers are there. It doesn't matter where it is. The math is put together because I looked at every single trade that I've taken and broken them down. The 0 days all by themselves. The Friday expiration trades. Got it. Good deal. And I've tried to like reverse engineer it backwards just to make sure that I wasn't screwing something up. I'm not screwing something up. The win rate, when I actually put them all in aggregate, is around 80, 88, 89. I have to check the numbers, but it's very close to a 90% when I aggregate all of the data together. Credit spreads have a really good win rate, especially when you do very simple things like don't trade stuff that look like Nike. Right? And yet this is the kind of stuff that new traders gravitate to. Like, oh my God, that thing moved $25. I've got to go get into Nike. Oh my gosh. Oh, I got to get it. And then they lose. So I know we're supposed to be focused on like introduction to options, but we had to come out at some point and start doing the journal talk and, developing trade logic on how we trade these options. Because without those, we're just spinning in a circle, right? Like without having some cement thing that says, this is how I'm going to day trade an option, or this is how I'm going to swing trade an option, so that we can do it consistently over and over. Pop is not about one single trade. And I've seen so many traders come in and they'll build a trade and they'll say, hey, I built this trade and it says I have an 80% chance of winning. No, you don't. You don't have an 80% chance of winning. Yeah, no, it says it right there, pop. Yeah, no, that's not for you. That's not one single trade, one single time. And then they get disillusioned, or they start to believe that the trade sucks or the strategy sucks or that they're failing and they're not doing it right because, well, it says I have a 75% chance of winning and I lost the last 3 in a row. This is stupid. It doesn't work and it sucks. No. You got to put the trade on over and over and over and over again and grow into an aggregate 76% win rate. Now, P50 is a lot more nuanced, and it does focus more on the trade that you're actually putting on right this minute. So if you build a trade and the P50 is, a 61%, that one particular trade this time has about a 61% chance of hitting 50%. So from that point of view, P50 is a lot more accurate to the immediate trade that you're using, but pop is not. Pop is like, well, I'm building a strategy and I want to target at a 70% win rate. Cool. Use pop for that. Yeah, the law of large numbers is key to everything, right? And if you think about it, standard deviation uses those large numbers. Mean reversion, linear regression, and that means Bollinger's, Keltner's, volume profile, standard deviation, literally the implied volatility. All of those things are using that math. The trade small, trade often, I totally live by that. Never putting on a trade big enough to hurt. I completely live by that. But we also have to be really careful about those small trades. And it mainly comes back to the math that says in a very small account, putting on the smallest trade possible, if we're putting on a 50-cent wide credit spread and we're collecting, say, $22 in credit, commissions take $2. So now, we made $20 credit. And then if we're going to close that early, we're getting around $9 or $10 credit. So we tied up $50 of capital to make $10. And if we're wrong, we're going to lose somewhere between $12 and $18. That's rough. So while we can trade in a small account, there's a reason that they call it small account challenge, because you are seriously handicapped in what you can and cannot do and the trades that you need to take. It's doable, but damn, it's difficult. It's very difficult. It is better to be working with more money. The more money, the better. Not because we can make the trades bigger necessarily, but because we don't have to close trades so quickly. If we can build that same 50-cent trade and we give it a month instead of 2 weeks, we automatically increase our win rate. Then, if we can hold it for 75% rather than closing it at 50, we may get stuck in the trade longer, but we're getting more returns. If you don't need the capital, leave the trade on, right? If you're not being threatened, leave the trade on. Now, that still has to be evaluated from the idea that to go from 50 to 75% profit might take you longer than it would take for you to open a new trade and go from 0 to 50 again. Right? Say we go from 0 to 50 and it took 1 month. To go from 0 to 75, or excuse me, to go from 50 to 75 might take another additional 1 month just to get an extra 25%. Well, that additional 25%, you could have closed the trade, opened up a new one, and closed the new one at 50% before this one hit that next 25% marker. That's not always true, but it's true more often than not, especially if that volatility starts to go against you. So that's something that, journaling starts to reveal. And by documenting those trades constantly, you can grow a better understanding of how long you're getting stuck in a trade on average. And there is that formula on Rock. I'll have to get the formula out because I don't have it printed where you guys can get to it, but I'll get it out. Everything has a pop. And if you combine that pop with the Rock, you start to develop a really clear understanding of how you're aggregating your money. And are you getting a good return for it? Because I've got clients that have a pretty good size account, $150,000, $200,000 accounts, and they're not generating enough money from those accounts to even be able to live on, to pay their bills, which is like completely crazy because I don't have one single account greater than $50,000, and I live on my trading. So, it's not how big the account is necessarily, it's what you're doing with it. And I kind of drew that a little off. It would be more like this. That looks more right. Right? It'd take like a month to hit 25%, 6 weeks to hit 50, and then there's 6, there's another 6, there's 12, 18 weeks before you finally hit 75. A lot of times it comes out that way, that there's a drag in that decay value, and a credit spread will get stuck near 50%, and it takes forever for that thing to go from 50 to 75. So, if you're in a small account and you need that capital rotation, a lot of times you're better off just closing it at 50 and opening a new trade up. You'll make more money because you're opening a new trade, and it can go from 0 to 50 a lot faster than your other trade could have gone from 50 to 75. And that's where that math comes from in those Tasty Trades videos or Tasty Works, where they talk about closing your trade early makes you more money at the end of the year. And closing your trade early increases your win rate. And that's absolutely true. But only if, right? Only if you're opening a new trade. Closing one down and then not opening a new one, well, you didn't do anything, right? You didn't benefit. All right, guys, short and sweet. That was the introduction to options this week. I did not put it into the PDF. We had to run the class early because there's going to be a webinar this afternoon. Don't miss out on that webinar. I think you guys will really enjoy it. Plus, I had an appointment this afternoon, so I wasn't going to be able to do an afternoon one anyways. Of course, bud, that's what we're here for. Answering questions, making sure you guys grasp this logic. Trading is so diverse. There's literally so many different directions that we can go that it gets to be hard to try to figure out what we want to do. But using something like this, where we go in and we talk it out, we provide examples, literally show you the way I do it for nothing else than just showing you, this is what I do. One of the many ways. Then you guys got a reference to go to, right? And there are the videos that I made on starting a trading plan. Those videos are excellent if you're new and you don't even yet have a plan. A strategy is one thing, a plan is another thing. I know a lot of people that just don't know what they want to do. They're like, well, I want to trade, but I don't know. Day trading looks fun. Maybe I want to swing trade too, and I want to do futures. I know I kind of want to do options. Working through that video series on a trading plan will help you narrow down what it is, because depending on the account that you have, or depending on the goals for your account, there's some trading that you just can't do, or that you're not going to want to do, because it won't be as effective as a different kind of strategy or a different plan.